executive summary version of a webinar that I recently ran, actually earlier today, with Simon Bylsma from Bellmont Securities. The title is How Accountants Can Turn Tax Strategies into New Revenue Opportunities. Quick disclaimer here, this is not intended to be financial advice or tax advice. Please seek your own advice where necessary. So the purpose of the session really was to look at some opportunities to engage with some maybe perhaps more self-direct type clients, people maybe with self-managed super funds, like to make some of their own investment choices. And what we talked about was that many of these types of people have lost trust in some of the traditional professional investment managed solutions available in the marketplace. Many of these types of people want more stability, more control over their investments and the decisions made on their behalf. And as some of these people make their decisions on their own behalf, we'll actually encounter some of their own decision-making biases and distortions, and there's some opportunities perhaps to help those clients. And from an accountant's perspective, we mentioned, well, actually, look, a lot of accountants have got relationships with these types of investors, but unfortunately, many accountants don't have a license to be able to talk about investment concepts in any detail with these investors. And also in the context of accountants perhaps having some pressure on traditional compliance-based revenue streams, but maybe adding value in this sort of context might be an opportunity to add a new revenue stream, a new value proposition for their. Looking at some behaviours, I won't go into this in detail, but we looked at why people tend to trade too much, and we talked about how that leads to some poor performance outcomes for investors, and perhaps why this is also more relevant for male investors than females. We then worked through a worked example of how overtrading frequency can create actual capital gains tax consequences for tax-paying clients. In this case, a $203,000 additional tax liability on $1 million portfolio over an investment period of 10 years. Simon Bylsma then picked up the conversation and went through a whole raft of different issues, which no doubt are familiar to many accountants and tax advisors, but are very easily missed either by investors or perhaps fall through the cracks between their various different advisors. And these included the franking credits, 45-day credit rule, some tax issues around the structuring of unit trusts and what happens when you change managers, some sort of opportunistic investment strategies around corporate actions, particularly the sort of share buyback with franking credit components, and some strategies around using the tax lot optimization strategies, particularly around where people's incomes and tax rates are changing, perhaps when they're moving into pension mode, for example, on their superannuation or receiving a bonus and that sort of thing. So there's some substantial investment-related tax issues with very big monetary dollar consequences attached to them. So herein lies the opportunity to better engage with and add value for some of these clients. Then we took a step back and said, well, from my perspective as an independent consultant to financial service professionals, accountants, advisors, and others, what can I do? And actually, in that capacity, my role is somewhat limited. I'm not an asset manager, so I talked about how I went out and looked for things that, or looked for solutions that potentially could tick a bunch of the boxes that we've just been through. So I look for things, professional investment solutions, offered clients direct share ownership to get some of those tax benefits that we talked through. It needed to be low turnover, again, to help with the tax consequences. There needed to be a low trust requirement. We needed to break down some of those barriers to people trusting some of these solutions. It needed to be simple and easy to understand, low cost and flexible. So we went through those various criteria. We talked about how Bellmont Securities and Behavioural Finance Australia have combined to create a solution which encapsulates both the sort of client engagement and sort of business development piece to assist people implement some solutions and talk to and engage their clients around these sort of things, and then the investment piece which delivers on those criteria. So Simon Bylsma then from Bellmont then talked through a couple of examples, case study scenarios, a couple of models, sort of demonstrated how the same principles around low cost, transparent, systematic, rules-based investing with a real eye to making sure those tax consequences are managed can help. It also can help accountants and sort of tax accountants and tax advisors, SMSF specialists in with different business models and with different objectives. And finally, I went through just a quick case example, a worked example of how the investment solution can incorporate a referral fee component in it, and how that can then benefit the business owners, the accountants, for example, in capturing a new revenue stream through adding this value to their clients. So a very small increase in cost to a client, 20 basis points, um, which, if it's delivered in the context of some substantial tax benefits, would be substantially in the benefit of the client. But also, there's a referral fee, as you can see under this scenario, $100,000, and $100,000 that's then corresponds to $600,000 of additional value in that accountant's practice. We answered a couple of questions and then closed off with where to go for more information. I've written a book, Behavioural Finance, Applying Behavioural Finance in Australia, which is available online. Check out my website, www.behavioralfinanceaustralia.com.au. It's available there, some sources like Amazon and others. And for more information, people are welcome to contact either me or Simon from Bellmont Securities.